Hi everyone. I'm the host of today, Yang Yu from University of Hong Kong, and our guest today is Iñaki, principal economist at the Innovation and the Digital Economy Unit of BIS. And because I have been helping with HKMA on the stablecoin policy research for 2 and 3 years, BIS has been playing a very important role, at least in Hong Kong, on the stablecoin policy making. All right, so floor is yours. You have Inaki, you have about 50 minutes.
Okie dokie. So thanks a lot. Good morning, afternoon, evening, depending on where you are. And thank you, of course, to the Luohan Academy for the kind invitation to speak today. What I would like to do over the next 45, 50 minutes or so is three things. So first, I would like to take stock of where the stablecoin market is and how it has behaved over the past couple of years. To also set out a framework for thinking about how stablecoins could affect the international role of currencies. And then finally, to walk you through three scenarios for how things might develop, with a particular focus on emerging market and developing economies. And along the way, I will share some evidence from ongoing work on the links between the stablecoins and the traditional financial system. So my talk today is 95% based on joint work with John Frost, also at the BIS, and Hirohito at Portland State University. So before I begin, let me remind you that whatever I say today reflects my views or our views only, and not necessarily those of the Bank for International Settlements. So with that, let me start with sort of four ideas that motivate the paper. A first one is an issue of scale and to some extent bias or concentration is perhaps a better word than bias. Stablecoins have grown very quickly, and about 98% of the market by value is pegged to the US dollar. So whatever stablecoins do to the monetary system, they are, at least for now, doing it on behalf of the dollar. Second is the issue of technology itself. So stablecoins are a new set of rails. They allow dollar claims to be transferred around the clock. They are programmable, and they move across the borders also outside of traditional corresponding banking system networks. So that is quite a step change relative to what we are accustomed to when it comes to moving money around the world. And the third is the kind of the emerging market angle, which is where I will spend a good chunk of the time in the second half of the presentation. And here the kick is that adoption of stablecoins tends to rise precisely where inflation is high, where the exchange rate is volatile, and also where payment frictions or capital controls or some other capital flow management measures are significant. And finally, the fourth sort of motivation is a set of policy questions that follow from the items that I just mentioned. Namely, what does this mean for monetary sovereignty, for leakage in capital flow management measures, and also for new challenges of financial instability. Now, the plan for the rest of the talk is straightforward. I will begin with the primer on stablecoins, what they are, how they are backed, or what are they backed by, and what are they used for, to the extent that we have some window of visibility into that. I will then introduce the framework we use, which it's coming from an old tradition in international economics. It's the Cohen-Kennan taxonomy of international currency functions. And then I will set it against the backdrop of dollar dominance that we know from traditional financial markets. And with that in hand, then I will lay out three scenarios for adoption, and I will close with some cross-cutting key takeaways. So let me begin with a few status facts. The first is that stablecoins are a small part of crypto, of the crypto ecosystem in terms of market capitalization. You see that in the left panel. Now, I have my reservations about market cap measures for crypto assets, especially unbacked crypto assets. But that's not open that kind of worms here. I would take that as face value. Now, despite that small footprint, they have become the principal settlement media within crypto, and that's what we try to show in the right-hand panel, where you see that stablecoin turnover dwarfs that of other cryptocurrencies such as Bitcoin or Ether, even though these two cryptocurrencies and backed cryptocurrencies together account for around 3/4 of total crypto market cap, as shown in the left hand panel. So the takeaway here is, stablecoins are small in market cap, but they are big in turnover, and that speaks to a bit to what are they used for to some extent already. A second fact, which played especially over the past couple of years, is that the market grew a great deal, and hence, the concern of many policymakers around the world. In the left panel, you see the market cap of stablecoins, where the dominance of the two largest coins, Tether and USDC, issued by Tether and Circle, is very, very clear. Growth was already kind of underway through 2024, but it received a significant boost from the US election in November 2024. And then a further boost came with the final passage of the Genius Act in around mid-July of last year. As the center panel and the right panel also shows, the boost was visible both for the stablecoins that would operate within the Genius mandate. To date, we label those compliant, although of course there is not, hasn't been enacted as regulation. So, but this is kind of a shorthand. We call them compliant, those that would be fitting the rules as laid out in the passage of the act. And at least temporarily, it also gave a boost to those that would not be compliant as of today. At the same time, you can see that the market stalled from early October 2025 onwards. And that happens to coincide with the peak in Bitcoin prices, which then went into sort of another bear market of sorts, with prices falling by about 50+%. Since then, there has been a bit of a recovery in the last couple of months, but it remained sort of flattish in the bigger scheme of things. And that foreshadows also a point that I will return to, which is what stablecoins are actually used for. A third fact follows from what we have just seen. Once you know that both Tether and USDC are pegged to the dollar, the market is overwhelmingly denominated in US dollars. And by the pure number of stablecoins, those pegged to the dollar account for around 2/3 of the market. But once you look at it by volume, dollar dominance is even more staggering. Around 98% of the market is pegged to the dollar. And I think this is the single most important fact for the international dimension that we'll be discussing I'll be discussing in a few slides. And it is why our headline message is that stablecoins for now are likely to reinforce rather than challenge any existing currency hierarchies. Now, what backs these coins? Reserve portfolios are somewhat heterogeneous across issuers, but there is a clear concentration in US dollar denominated instruments for the dollar pegged arrangements that dominate the market. So basically for USDC and Tether and USDT. Now, across the largest stablecoins, the fiat back issue, the issuers will typically hold some combination of reverse repos. They would also hold publicly issued debt securities, US Treasury securities, US Treasury bills for the most part, and they would also hold some cash or cash equivalents in different proportions, right? So Tether, for example, which was notorious for its lack of transparency and was rumored to hold low-quality private commercial paper some years back, now holds a significant share of its reserves in US Treasury bills. It is also unique among the major issuers in continuing to hold other cryptocurrencies and other volatile assets as part of its reserve portfolio. Circle, in its backing of USDC, holds a mix of treasury bills, but mostly overnight reverse repos, while PayPal USD is mostly doing reverse repos. Now, a broader point here is that transparency varies a great deal across the issuers, both in the frequency, but also in the scope of disclosures, and also in whether these disclosures are independently audited, right? And that bears directly, of course, on the credibility of par redemption, of their promise of par redemption, especially under stress. Now, a few issuers will publish reserve information very frequently, even daily, in the case of USDC. Others would disclose only quarterly or on a sort of an ad hoc basis. Tether, again, the largest of all, has to date issued no audited financial statement whatsoever, only attestation reports reviewed by by the firm BDO Italia. And because the closures are also often consolidated across several products, think of a dollar token, a euro token, a gold token, then the attribution becomes quite difficult, with portion of reserves sometimes being described in terms of things that are hard to classify. Think of quote unquote secured loans. It's not that clear what those are. Now, the absence, of course, of standardized auditable reporting is exactly what makes a confident judgment about reserve quality so difficult, and also makes the trusting of par convertibility under stress also difficult to achieve in all states of the world. Then, of course, we have the crypto and commodity-backed coins, which would add further wrinkles. Some of the crypto-backed arrangements will rely on over-collateralization with volatile crypto assets, and also on liquidation rules that are coded into smart contracts. And some, such as DAI and Frax, are themselves partly backed by other stablecoins, which is precisely why they lost their peg on when USDC briefly did peg during the Silicon Valley Bank episode. I have a separate paper where we look in quite a bit of detail on that episode. Now, let me turn to use cases where I think a lot of the hype meets reality, so to speak. Much of the turnover in stablecoin markets is automated activity. It's intra-exchange transactions, bots running arbitrage and rebalancing across portfolios, also wash trading, as was documented in very nice work by Will Kong and others. Now, when you try to correct for this, the adjusted measure of stablecoin transaction value is only about 10 to 15% of the unadjusted figure. That is what we show in the left panel. So the headline numbers, which are the ones that are usually quoted in the press to argue that stablecoins already dwarf established payment systems, for example, when this is stacked against the transactions processed by Visa and so on, tend to be a bit overstated, of course. Now, within those adjusted volumes, only something like 0.4 to 0.9% of activity is of a size that would be relevant for retail, which is measured here in the graph on the right as being under $250 transactions. So you see that retail size transactions are in the legend, but they are barely visible. And that also puts a bit of a question mark over industry claims that stablecoins are already used at scale for retail use cases such as small denomination remittances. Now, this slide makes sort of a similar point, but a bit more directly. So this is based on a survey. Use today is dominated by crypto trading pairs, on-chain liquidity provision. Payments are a sliver. This includes business-to-business payments or to consumer, person-to-person. On and off ramping and tokenized real-world asset settlement are larger than payments, but still remain relatively small. So the honest summary here is that much stablecoin use remain sort of tethered, with the pun intended, to crypto activity itself. And the interesting question, therefore, is more about where this could go rather than where it is today, and especially the concerns are around where this could go potentially in the future rather than where it is today. Now, all of this said, none of this means, I think, first, that the market is not growing, and second, that there are already measurable effects in the traditional financial system. Now, one use case that has seen that has been growing is cross-border payments. Here, measurement is very hard because of, in no small part, because of pseudonymity, also because of the fact that trading is concentrated on exchanges, and it's hard to allocate them amounts transacted to individual jurisdictions. But there are some workarounds. There are some rules of thumb, some ad hoc rules. And in work by BIS colleagues, as well as other work by IMF colleagues that use several approaches, shows that from early 2022 onwards, cross-border flows in the largest dollar-pegged stablecoins grew quite a bit. At times, it even surpassed that of Bitcoin and Ether, which I do not show in the left panel, but is there in the original paper by BIS colleagues for those interested. Now, the right panel, to my mind, is the more interesting one, and it shows, also based on the same paper, which country level factors are associated with higher flows. And there are two that stand out. One is high inflation, and the second one is exchange rate volatility, both in the sending and the receiving country. So in other words, foreign currency stablecoins are being used as a de facto store of value and payment instrument precisely where the domestic monetary framework is weak. And I think here there are a couple of extra nuances that are worth drawing out, even though they are not reflected in the graph itself, but come from the research by IMF colleagues. So first is the regional pattern. The Asia Pacific region leads in absolute activity, but relative to economic size, the flows are larger in Africa and the Middle East, and also in Latin America and the Caribbean. And then flows between emerging markets themselves feature quite prominently, and they look quite different from the traditional payment patterns that are routed via messaging systems like Swift, or what we know from the routing of those payment messages. The second nuance to highlight is that the efficiency case, while arguably real, is also easy to overstate. There are, I think, genuine gains from continuous around-the-clock operation and also from reduced reconciliation costs, but the end-to-end frictions remain quite salient. The cost of converting in and out of at the on and off ramps affects conversion spreads, compliance requirements under standard anti-money laundering rules to which traditional financial intermediaries must abide with, and also fragmentation across different blockchains and issuers. All of this can erode a good deal of the headline benefit. And there is a very nice recent paper by Wenxin Du and co-authors that actually goes through some of the nitty-gritty details of the computations of these different routes, and comes up with a takeaway or take-home message that is not that rosy, not that negative either, but also not particularly rosy. Now, finally, let me know that high inflation and exchange rate volatility are also hallmarks of what the literature or international monetary hierarchies calls financial subordination. And that points to a sort of self-reinforcing dynamic, detrimental self-reinforcing dynamic, whereby economies that are already financially subordinate, they will face the very conditions that make stablecoin adoption more likely, and then widespread adoption of stablecoins that in turn risks entrenching a new sort of digitally mediated form of subordination. So some of these jurisdictions, some of these emerging markets might be sort of in a catch-22 sort of situation. Now that brings me to the framework, and to assess how stablecoins might reshape the system, we anchor the analysis in the canonical taxonomy developed by Cohen in 1971, then refined by Kennan in 1983, and used thereafter, most notably by my co-author Hiro Ito in work with Kawai. Now, this framework basically organizes the international use of a currency along two dimensions. The first dimension is the three classical functions of money theory: unit of account, medium of exchange or medium of payment, depending on the emphasis that you want to put there, and the store of value. And then the second dimension is the two categories of users that can make use of money in these three ways, and those are the private sector and the official sector. And that gives you kind of a 3x2 matrix with the 6 cells that you see in the table. Now, let me anticipate that our headline conclusion is that in the near term, stablecoins are most likely to disrupt the private sector store of value first, then the private sector means of payment functions. And given the dollar peg, they're likely to reinforce rather than overturn the current international hierarchy of currencies, as already emphasized earlier. Now, a value added of this framework, we think, is that each cell can be mapped into something that one can actually measure. So let me take the 6 cells one at a time, just to use examples of some of the measures that can be used. And Hiro has a separate paper with Kawai in which they actually go into much more detail into mapping each of these cells into observable, measurable items. So let me start with the unit of account. So that's the upper row. Now for the private sector, this can be captured, for instance, by the currency of trade invoicing. Let's think of the share of a country's exports and imports that are denominated in a given currency, as is also standard in the dominant currency literature. When it comes to the official unit of account, the relevant notion is the anchor or reference role. So that's the extent to which countries, for example, stabilize their exchange rate against a given currency, therefore sort of forming currency zones. This is the measure that is used actually explicitly in the paper by Hiro and Kawai. Next, we can look at the means of exchange in the second row. The private means of exchange function is reflected in, among other things, it's reflected or could be captured by FX market turnover. So that's a share of global transactions in which the currency is one leg of the trade. When it comes to the official medium of exchange, this could be captured, for example, by the currency that central banks actually use for FX intervention in order to stabilize their domestic exchange rate. Finally, there is the private store value function, which shows up, among others, in the currency composition of cross-border bank claims, of international debt securities, and of activities, say, in interest rate derivatives and potentially also other derivatives markets. And then when it comes to the official sector store value, the most familiar indicator of all is, of course, the composition of official FX reserves as coming from standard data sets like the IMF COFR data. So which of these cells is most exposed to stablecoin, and then in what order? That's kind of the broader question that this framework allows to entertain. To answer that, I think it helps to think about how currencies have historically climbed the ladder of international use. And here there is, to be fair, genuine disagreement in the literature. So you have the dominant currency view of say, Gopinath and Stein, that will put the medium of exchange first. So once the currency becomes the vehicle for transactions, then kind of the rest flows. There is a post-Keynesian tradition as well, which instead foregrounds the unit of account. So denominated contracts and debts in a currency is what anchors its role. And then there is a third view that holds that the store of value comes first. So agents basically reach for a safe and liquid asset before they adopt a currency for transactions. And this is the approach of Ito and Kawai. Now, for stablecoins in emerging economies, we argue that the store of value is the most likely point of entry. And the reason is the demand that we actually observe. So in a high inflation, volatile exchange rate setting, the immediate appeal of a dollar stablecoin is preserving purchasing power, not invoicing trade, not settling, your weekly shopping list. And that is exactly what the cross-border evidence on the previous slides were also telling us. And it also carries an implication, which is that stablecoins could remain primarily vehicles for saving and speculation, rather than evolving into sort of genuine transaction media. And this is particularly more likely to be the case where wages, contracts, and tax obligations stay denominated in local currency. So the sequence we envisage and discuss in the paper is, first private store of value, then private medium of exchange, and then with the sort of the highest buyers of all, the private unit of account, with the official sector functions basically lagging throughout. And the idea, of course, here is that each step along this chain demands more and more in the way of network externalities than the last. Now, let me run through the functions of that logic before moving further. I think the private store of value, of course, is the most exposed, as I say, in the near term. You can, this is not hard to imagine why, right? So self-custody in an unhosted wallet would offer an autonomy that a bank deposit does not, and this could raise the dollar share in what you might call private international reserves. All the more so if stablecoins begin to pay interest, which is, of course, a highly contested issue at the moment. The private medium of exchange is sort of underway, but also from a very low base, mainly in costly remittance and business corridors. And then the private unit of account, again, faces the highest barriers because invoicing conventions are sort of very, very deeply entrenched. Though, of course, if a currency comes to be widely used both as a store value and also to transact, then prices may eventually begin to be quoted in it, which, given the peg, will simply mean being quoted in dollars, of course. And then official sector functions are unlikely to be directly affected soon. Central banks have, for the most part, with very few and very small exceptions, stayed completely out of this business of buying any crypto asset whatsoever. But they can be indirectly constrained if the private sector adoption becomes sort of a stealth dollarization that erodes policy autonomy, and their hand may be forced, like sometimes is in cases of extreme dollarization episodes. So before I mention that stablecoins are something that will likely reinforce current monetary hierarchies, and to see why kind of reinforce is the right word, I think looking at this graph and looking at where the dollar already stands is quite instructive. Some of you working in international finance might be familiar with many of the indicators in this graph. The dollar appears on one side of close to 90% of all FX transactions. It accounts for roughly 60% of cross-border banking claims, nearly half of all IDS or international debt securities, more than half of official FX reserves, trade invoicing, SWIFT payment messages, interest rate derivatives, and so on and so forth. And in every one of these, the dollar share is standing way in excess of the US share of global GDP or global trade, which is what you see in the red bars on the left. Now, I think it's worth pausing for a bit on why this dominance is so durable. It emerged basically from particular historical circumstances, but it also persists because it is self-reinforcing. Traders invoice in dollars because they expect their counterparties to do so. Banks hold dollar assets because that is where the liquidity is. And central banks also hold dollar reserves because the dollar is the vehicle for intervention as well. So all of these maps to an important extent to the indicators that the taxonomy gives us, and for which we are trying to put some numbers in this graph. Now, the way we as economists formalize this is as basically network effects and increasing return to scale, and it is what underpins the so-called exorbitant privilege that the United States enjoy. Although, to be fair, there are some that argue that there is an exorbitant burden side to the equation, but I will not get into that. There is also, of course, a structuralist reading here, which is that is closer to the financial subordination literature with which we engage in the paper as well, that sees this same hierarchy as a structural dependence of developing economies on advanced economy currencies. Either way, be that as it may, I think the dollar's position is anchored by far more than the size of the US economy, and that much is clear from this graph. And the punchline, or the bigger punchline of the chart, is that is also the stablecoin bar, right? The dollar share of the stablecoin market, which we already went through, is at 98%, is way higher than its share in any traditional market. So if stablecoins scale, then the first order effect is to extend the dollar reach, not to diversify away from it. That much is super clear. Now, before going further, I think it's worth keeping a sense of proportion, and ideally, I always like to do this with a bit of humor. So I'm poking some gentle fun here, using the case of Europe as an example. The point is that while a great deal of concern is expressed about a few $100 billion of stablecoins and what they mean for monetary sovereignty, there are already something like $2.7 trillion trillion US dollar bank liabilities that are booked inside the euro area today. So the offshore dollar system is actually enormous, and it's a long-standing creature. So stablecoins are new and salient, but they are still very small against that backdrop. And I think having that backdrop in mind is also useful to understand how stablecoins may change things, if at all, going forward. The graph in this slide makes this comparison or this joke in a bit more serious manner. In work with Perry Merling and Dan Nielsen, we drew the analogy between stablecoins and offshore dollars, or euro dollars, as they are sometimes called. And using BI statistics, we can compute offshore fiat money for the major currencies. And this is what we plot here, the two major on the left and the rest on the right. And where on the right, we also add stablecoins for perspective. So as you can see, the US dollar is effectively global money, and offshore dollar liabilities booked by banks outside of the US are in the neighborhood of $14 trillion, which dwarfs the stablecoin market, of course, dwarfs any other currency for that matter, or any other offshore currency. But as also the right panel shows, stablecoins have already grown to exceed offshore Swiss francs. That is, Swiss franc liabilities booked by internationally active banks outside of Switzerland. And I mean, of course, the analogy is with euro dollars, with offshore money in general, is instructive, but also has some limits. So both offshore dollars and stablecoins emerge from a mix of financial innovation and regulatory arbitrage, but offshore dollars still operated from the get-go within broadly regulated banking channels, and also in extremis, they are backstopped by central bank swap lines, as was the case, of course, under severe stress in 2008 and 2020. Stablecoins, on the other hand, they circulate as a bare instrument on a public blockchain, largely outside of banking regulation, and so far without explicit backstops. We'll see that whether that remains the case. Be that as it may, that's a structural difference that makes stablecoins potentially more disruptive to capital controls, to FX regulations, even at a much smaller scale. And I think there's also one more structural point that matters for what I will be discussing in the remaining part of the talk, which is like unlike offshore banks, which create new dollar credit, stablecoins issuers, as they are currently constituted and the way they function, they do not lend against reserves. So each token is in principle fully backed. So in that sense, they behave much less like a credit creating intermediary and much more like a narrow bank, which limits their capacity to generate credit elasticity, which is very important to make the system function smoothly. Now, of course, that might not hold forever. You can imagine a future in which stablecoins become a widely accepted means of payment. And if that were the case, then issuers could, in principle, start buying assets simply by issuing new tokens that the counterparties will accept at par, much as banks create deposits today, because it is, by definition, under that hypothetical scenario, a widely accepted means of payment. And therefore, stablecoins would share what some of my colleagues have called the exorbitant privilege of money creation. And that would be, of course, a very different world, also with real implications for credit and monetary transmission. And from an EME vantage point, there actually might be a better analogy than the euro-dollar market altogether. Again, euro-dollar sit inside the elastic sort of credit infrastructure of advanced economy banking. Stablecoins, by contrast, look much more like traditional dollarization from the perspective of an emerging market, or even like a currency board. Each unit in circulation must be backed by reserves in the reference currency. There is no lender of last resort, and pressure on parity will act as a market signal of stress. Now, the crucial difference is that this discipline is imposed not by a sovereign monetary arrangement, but by private issuers that operate on a public blockchain, again, largely outside the regulatory perimeter. So where could all of this go? In the paper, we sketched 3 scenarios. Let me be very clear here. They are not forecasts. They are not mutually exclusive across countries. They are just tools for thinking about the range of possible outcomes. So it's just an exercise in hypotheticals and trying to think through what those hypotheticals mean. So there is a first scenario we entertain that we call niche adoption, with crypto-centric use persisting as it is today, real economy penetration staying broadly limited, so macro and sovereignty risk remaining there, but still modest in the bigger scheme of things. A second scenario, which we label digital dollarization, there you can have foreign currency stablecoins becoming de facto payment rails. You can have more widespread currency substitution, bigger policy leakage, and also FX market cementation intensifying. And then there is a third, more rosy, quote unquote, if you wish, scenario of domestic integration, where authorities license regulated local currency stablecoins that then improve payment efficiency while also preserving monetary control for the authorities that are licensing these financial intermediaries. Now, the policy stakes, of course, will cut across all of these 3 potential scenarios. That is, you need to safeguard monetary sovereignty, capital flow management. You need to ensure reserve quality, reserve redemption, redemption and transparency of the reserves, potential interoperability with fast payment systems, and also potentially with CBDCs where relevant. And then throughout, you need to have cross-border supervisory cooperation. We see in the paper we write, and we see the first two scenarios or some combination thereof as the more plausible near-term paths. So niche adoption is essentially today's baseline, and digital dollarization captures the risk in vulnerable economies. So there are some footprints of this in the data as well. The third may be seen as a sort of attractive, as an aspiration of sorts, but of course it demands regulatory capacity that many emerging markets might not have available, at least yet. So let me walk in a bit more detail through each of the three scenarios. In the niche adoption scenario, we have stablecoins remaining primarily instrument for on-chain trading. Think your market making, your arbitrage, your DeFi investments or speculation, with very limited or sparse real economy payments. You can think of residents in a handful of high inflation economies using stablecoins as an offshore or better like on-chain store value, but everyday payments continue to be denominated in the local currency. You can have confidence being hit every now and then by hacks, by the pagans, by runs, and therefore mainstream merchants remain reluctant given compliance burdens, given price volatility, and at the on and off ramps. The macro implications under this scenario would be also quite limited. There would be capital flow management leaks through peer-to-peer transfers and also some happening in exchanges, but then the volumes would be small relative to overall balance of payment flows, and then central banks would keep a meaningful lever or by policy traction, which means that also financial stability risk would remain concentrated within crypto, which means in this scenario that the broader financial stability risk would not be that concerning. But even here, there's going to be a subtler effect, right? Which is that the mere fact that you have this availability of dollar stablecoins as an outside option will impose a form of market discipline. So the knowledge that residents can shift into stablecoins relatively easily will raise the expected cost of unsound macro policies, even if actual adoption stayed modest. So there's still some potential effect that could be felt across countries. Now, I think this scenario is also where the regulatory debate is the liveliest, in the sense that should supervisors focus on consumer protection? Should they focus on anti-money laundering compliance? Should they focus on systemic oversight? Does formal regulation risk legitimizing the sector and also weakening the kind of quote unquote buyer beware warnings or caveat emptor warnings? And I think it's also worth dwelling on the fact that some jurisdictions will actively choose to keep adoption at this level. And I think China is, of course, the instructive case here. There was a comprehensive ban on crypto trading and mining since 2021. This was reasserted in February this year, which effectively keeps stablecoins out of the domestic system. And that shows, I think, what is possible with sufficient regulatory capacity and political will, if you will. But then, of course, replicating this requires control over digital asset points that many emerging markets will not have. And then where enforcement is also weaker, then even strict bans can prove, porous, which is also the pathway into the second scenario. Of course, China is I mentioned this as a high capacity case, but the agency of emerging market states is going to be broader than that. Another case that we go through in the paper is Nigeria, which is a useful counterpoint. Authorities there directed banks to close accounts linked to crypto activity in early 2021, then reverse course, and then issue a licensing framework in late 2023 before imposing fresh restrictions again on specific platforms in early 2024. And the reason we bring this up in the context of the paper is that this back and forth captures both, the kind of the genuine desire to assert monetary sovereignty from an EMEan perspective, but also the sheer practical difficulty of sustaining a prohibition when enforcement capacity is limited, and also the underlying demand simply just doesn't go away. The second scenario, we have dollar stablecoins becoming the de facto cross-border retail payment infrastructure in some EMEs, with spillovers into domestic pricing, into domestic settlement. The drivers under this scenario would be economic, so materially lower FX spreads than the banking system, Near Eastern settlement, and also kind of a dollar brand that signals stability in high inflation environment. And then network effects sort of do the rest. Domestic banks under this scenario, rather than resisting, could potentially start offering on and off ramps and even stablecoin denominated saving products themselves, which of course could accelerate deposit dollarization. And then the macro consequences under this hypothetical scenario would be much more serious, of course. Monetary policy would lose traction because it kind of bites on a shrinking share of activity. Exchange rate pass-throughs could accelerate, and also savings held in dollar stablecoins are going to be effectively intermediated abroad into U.S. Treasuries rather than financing local credit. And there are some fingerprints of these sort of effects in the data. So the chart that I'm showing here is shows the distribution of what we call parity deviations by currency. So that's the wedge between the stablecoin implied exchange rate and the traditional exchange rate. For the advanced economy currencies on the left, you see that the wedges are very tight, so around 1. For the EME currencies with capital controls and multiple exchange rates, those are on the far right, and the wedge with a separate y-axis because the order of magnitude is different. You can see that the wedges are large, and while I'm not showing this in this cross-sectional graph, they are also persistent over time. Now, these deviations are sort of a reveal preference evidence of demand for dollar instruments that may circumvent official channels. Like the intuition for these measures is it comes from a clean, simple, no arbitrage argument. So imagine someone in an emerging market who wants to hold a dollar stablecoin. This person has two routes, so she can buy directly, pay local currency for the coin on an exchange, for the stablecoin, right? Or she can do it indirectly. She can use the local currency, buy dollars at the spot FX rate, and then use those dollars to buy the coin at close to 1-for-1. And in a frictionless, fully integrated market, then the two routes should cost the same. And then when they do not, and typically the direct route is more expensive, you get a positive parity deviation. And those deviations are systematically larger again for economies with macro instability, capital controls, which is exactly why the boxes on the right of the chart are so much wider than those on the left. Now, these are not just correlations, but they put what I just showed you are just correlations. But in the paper where this is coming from, which is joined with Paola Beltran and Federico Grimberg from the IMF, we causally identify the effect of stablecoin flows on FX markets using an instrumental variable strategy. And what I show here is impulse responses from local projections. We show that an increase in instrumental stablecoin flows lead to wider parity deviations, so higher deviations of the type that I was showing you in the previous slide, and also some cumulative depreciation of the domestic currency. We also show in the paper that they also lead to wider deviations from covered interest parity, another standard no arbitrage condition in international finance. And once you take all of this together, this is evidence consistent with segmented FX market and also genuine policy leakage in that stablecoin provide a channel that gets around measures like, for example, capital controls or FX regulations, which emerging markets might have very good reasons to institute for whatever domestic policy goals. There is, of course, a second channel that I think is worth highlighting, through which the footprint of stablecoins is already visible, and which plays out on the asset side of stablecoin issuer balance sheet rather than on FX markets. And that arises because dollar stablecoins hold their reserves overwhelmingly in short-dated US T-bills, as I showed earlier, which means that they have become a meaningful investor in the treasury bill market itself. This is what we show in the chart. You can see the stablecoin issuers taken together as an aggregate. So this comes from the 6 largest US dollar pegged stablecoins. This collective basically sits on a par with the largest US government money market funds, and also ahead of most major foreign holders in both a stock perspective. That's a graph on the left, so how much they hold as a stock variable, but also in terms of purchases or in terms of flows, and that's what we show on the right. This, by the way, the flows apply to what happened over 2025. And the natural question, of course, is whether this affects treasury bill yields. And in work with Ahmed, which is where these couple of graphs are coming from, we find that inflows into stablecoins, think of the market expanding, so market cap expanding, puts downward pressure on T-bill yields, but also in a way that depends heavily on liquidity conditions. When market liquidity is plentiful, that's the left panel, then the effect is there, but it's very small. When liquidity is strained, I will not go into the definitions. We use various definitions of straight treasury market liquidity. Then the effect is considerably larger and also clearly statistically significant. So the safe asset channel is real as well, but it's state dependent. It matters mostly when the treasury market can least absorb it, which is also potentially a source of extra financial stability concerns if the market were to continue to grow. Now, let me move to the third and last scenario, which is kind of the more constructive one, if you wish. Here, multiple emerging markets could license banks, fintechs, other market infrastructures to issue local currency stablecoins. Those would interoperate with national fast payment systems, and again, were relevant with CBDCs. And so here, rather than kind of giving ground to foreign stablecoins, and authorities would try to harness the technology to modernize their own domestic payment system, while at the same time critically keeping a bit more monetary control. Now, a key design feature under a hypothetical scenario like this one is that reserve backing would be strictly ring-fenced in central bank reserves, in bank deposits, or short-term government securities. And here there is a clear contrast as well with digital dollarization, in that if reserves are held in domestic government debt, then local currency issuance can actually support demand for domestic, so local stablecoin currency issuance can support demand for domestic sovereign debt and keep savings within the domestic system rather than channeling them into securities of other jurisdictions. Now, of course, the macro implications here would be more benign, though of course they are not trouble-free. I don't think they ever are, probably. Payment efficiency and financial inclusion could improve under this scenario, but banks also would face structural pressure as deposits migrate to stablecoins, which would then compress margins, could reshape the financial system towards a sort of a narrower banking model. Capital flow management will remain challenging here as well, because issuers could still swap into foreign stablecoins on the centralized exchanges. But at least the way we set up this scenario, which of course, again, is kind of arbitrary and debatable, here authorities could have a bit more visibility and more points of intervention, because they would be, in principle, regulated on and off ramps that are kind of a natural choke point for know your customer and anti-money laundering checks. And then a defining feature of this scenario is that regulatory frameworks will diverge quite a bit across jurisdictions, because some will treat stablecoin issuers as narrow banks under full prudential supervision. Others may treat them and regulate them as e-money institution with sort of lighter capital and liquidity requirements. And others would still build bespoke categories that distinguish, say, tokenized deposits from stablecoins, and have a separate regulation for each. And that heterogeneity, of course, has a double-edged nature to it, because it allows useful experimentation, but at the same time it complicates cross-border interoperability and then opens the door for regulatory arbitrage. Issuers could just charter where the rules are loosest and then serve users elsewhere. Now, of course, the upside for citizens and firms is choice. You have a monetary ecology in which you can pick among different forms of digital money according to your needs, as defined by preferences for privacy, for programmability, for remuneration, if that may be the case, and also for protection under different states of the world. Now, there are two extra risks that I would flag here. One is political capture. If governance is weak, then domestic issuance could be used to extract seigniorage or channel funds to favor ends that might not align with the maximization of welfare. And the other is operational. So you could think of a domestic stablecoin that becomes a widely used payment instrument, and you have an operational failure. Imagine like a 51% type of attack on the underlying blockchain. This could impair access to critical payments and would be a major societal risk. Now, these risks, of course, are familiar from existing payment systems, but public blockchains add their own technological wrinkles to it. Now, the map I'm showing on the slide comes from the FSB, the FSB review of the implementation of the high-level recommendations on the regulation of global stablecoin arrangements. So this is a review that was done over the past year and was published in December, and makes a broader point based on actual data that implementation of the international standards is highly uneven across jurisdictions, even without going into the third scenario that we are speculating about, which is itself a source of risk. Let me try to pull these threads together with the 5 cross-cutting points, and then we wrap up. So first, outcomes will be highly heterogeneous across countries. Economies best placed to channel stablecoins toward local currency instruments and keep policy autonomy are those with credible monetary frameworks and effective capital account policies to begin with. So the economies that are most exposed to rapid dollarization are those with the weaker institutions, with high inflation, with limited financial access, which is again sort of a self-reinforcing trap, and that cuts across scenarios. Second, regulatory choices in the major jurisdictions, of course, will very likely shape global outcomes. The US Genius Act is explicitly designed to entrench dollar stablecoins. The EU's MiCA regulation includes safeguard against non-euro stablecoins and monetary policy transmissions. Now, these frameworks are very likely to create path dependencies that then, if anything, will privilege the dollar and the euro and reinforce existing hierarchies again. Third, there is a great deal of activity that sits outside the regulatory perimeter. So the way some colleagues have put this is that it is as if authorities build sort of this luxurious regulatory house, and then crypto innovators just camp outside of the house. And then the challenge is to bring, of course, legitimate activity inside while combating the genuinely illicit, money laundering, terrorism financing, and so on. And here, the traceability of blockchains could potentially help. Fourth is the interaction with other forms of digital money, which I already mentioned. If CBDCs offer similar functionality with more safety, they may limit stablecoin adoption, and then if not, stablecoins may thrive in niches. I think a sensible goal is to have a monetary ecology in which different forms of digital money coexist and interoperate without fragmenting the system, of course. And then the fifth consideration is it comes to the map that I was showing before, meaning that international coordination is essential, whatever scenario materializes, because stablecoins are inherently cross-border. So, reserve standards, disclosure, cross-border resolution, etc., cannot be handled by national authorities alone. And of course, here there is an obvious political economy angle, which is that if standard setting is dominated by the same jurisdictions whose currencies and firms anchor the market, then the rules risk entrenching existing asymmetries. And from an EME perspective, the paper focuses on ensuring that emerging economies have a voice in shaping global stablecoin governance. It's also important if coordination is to preserve also the policy space rather than constrain it further. So with that, I'm done. I thank you very much for your attention. I'm happy to discuss. Let me stop sharing.
Yeah, okay. So should I ask a question first or directly go to I got a few questions from the audience. So maybe let me ask one question. So about so you showed like the crypto trading and kind of trading pair accounts for 80% of the current use. So how did you do the calculation, particularly like on Ethereum, more than 90%, more than 95% address are anonymous. How would you interpret all those on-chain transactions? It has already maybe 1 trillion or close to 2 trillion per month now. So what's the data source for that kind of class?
So I showed a couple of graphs. So they had this graph which was a bar chart that were displayed horizontally. That comes from a survey that was conducted by Boston Consulting and Visa.
Yeah.
So I'm not entirely sure how the sausage is made there. But I mean, of course, this is a major issue because as you mentioned, it's very hard to assess this. Then there is the other data that I show on adjusted and unadjusted volumes, and that comes from the Visa on-chain analytics. I think it's called. It's a dashboard that provides some information. They are more forthcoming in providing the details of how the sausage is made, but still you have to trust them in terms of how they do the allocations. There is a paper that is coming out, I think this week, by BIS colleagues that actually looks at that for stablecoins in particular. So I think hopefully that question will be answered a bit more looking at Ethereum, exclusively at Ethereum, but looking at millions of transactions and analyzing what they are used for with some rules to try to account for that. In our paper, we basically take the measures that are out there as given at face value, and effectively we don't question them that much. But of course, one should.
Yeah. Okay. Okay, great. So let me ask the questions from the audience that I get from the list. So what is the fundamental reasons that altcoins represented by the stable coins can never be directly used to buy things? I think it's a question about the day-to-day adoption of stable coins that we haven't seen that yet. Any
Mhm.
comments?
Yeah, I mean, I think that's a great question, and then it's also a deceptively simple question, but actually goes deep into what makes money money, which goes back to the network effects and that underpin social acceptance of money, right? So if ultimately the fundamental reason is that people will not trust that they can use, it's not a generally accepted means of payment, so people will not trust that they can use this for their own payments. So when you give this in payment for something to, say, Starbucks, when you buy your coffee, then Starbucks trusts that it can use, in my case, the Swiss francs that I'm giving them to actually pay suppliers, pay for their coffee beans and whatnot. And that would be accepted with no questions asked, so to speak, in the parlance of Gary Gordon. Now, there is no similar trust for stablecoins yet.
Mhm.
I mean, we'll see whether there ever will. I don't want to rule out that that's a possibility, but you can conceive of scenarios in which it is a widely accepted means of payment. But that is a function of general acceptance, of support of public authorities, of regulation, of resilience under stress, and so on. Many conditions of which are not fulfilled by stablecoins, at least as we speak. Then the future might change.
Yeah. Okay, so the second question from the audience. So what's your prediction about the stable coin development in the future? In what kind of circumstance that it will continue to grow, or that might in what kind of scenario that might wind up?
Yeah, that's also, I think, a great question. I mean, I can only speculate, of course. So this is about, as the saying goes, it's very hard to make predictions, especially about the future. So I can give you my own take based on what I have read and the evidence that I have seen. I don't think they will die forever. So I think they are here to stay in some form or another. Uh, I also tend to not think that much they will take over the financial system. That's why in the paper we argue a bit more in favor of kind of a status quo scenario, which would be the niche adoption with some elements of the digital dollarization. Um, so that would be my answer there. So I don't think they will definitely die out forever. I find it hard to foresee a scenario under which that would happen, because I think there will always be some demand for it, at the very minimum for illicit purposes. But I think beyond that, for sure, I don't want to be unfair there and say that it's only for illicit purposes. And for some EMEs, there's still a structural demand. So I come originally from Argentina, right, where a lot of people there do not trust the peso and will hold whatever form of dollars they can get their hand on. And sometimes getting actual dollars is not that easy, but getting a pseudo dollar or a promise to pay a dollar, which is how I think about a stable coin, is the next best option. So there you have like some true, genuine, real economy demand for them. It might not underpin like $1 trillion market, but might still give some use cases for it. Um, And so that kind of answers I think the second part of the question, which is that they're definitely coming to being forever. So I think they will remain part of the monetary ecology, most likely. Again, just a guess, an educated guess. Um, but I would not think that this, coming into being forever, as the question puts it, implies full financial market dominance, as in, these are the instruments that we'll use for our everyday payments on a regular basis.
Yeah, hi, Professor Chenlong. I see you here and raise your hand. So, yeah.
Oh, yes. Hi, so Iñaki, this is long-term from Luohan Academy. I have two related questions, and I think it's probably partly answered by you, but I want to clarify a bit more. The first question is regarding the general trend of this. Now it's dominant, the stablecoin is dominant by the US dollars, on-chain US dollars. Do you believe this major trend, all the major economies will have their fiat currency to be on-chain, to be their own version of the stable coin? So I guess the related question is, how important is this? How big a role will this play in the financial sector system, and will the countries, all the major fiat will have their a second question is, what do you think is there a consensus on the players, like the emerging markets, middle-sized country players, or the bigger players? What would be their proper response to this innovation, kind of regulation innovation initiated by the United States?
Okay. So on the first question, so again, these are, I think, great questions, and of course, my answers are kind of my own educated
Of
guess,
course.
speculation about them,
Yes.
the usual disclaimers as always. Now, what happens if other countries have their own, currency denominated stable coins, and how would that change the market? I think that I interpreted your first question in that way. The way I think about this is I try to look at the market and the signals that the market is telling me. And if I look at the market today, and the signal that is telling me is that the market wants dollars, and it wants dollars in a completely disproportionate way relative to how it wants dollars for anything else, as that chart that I showed you was illustrating, right? Where you saw cross-border claims and FX turnover and so on. So all of this to say is that if you can, I think you can issue your own domestic currency denominated or domestic currency pegged stablecoin, I find it hard to see where the demand for that is going to come from. So that is, I think, the main issue that I see with those, and why I'm a bit skeptical that they will make a dent on the market. So I think that just having the tool there, of course, is a prerequisite for you using it, but there also has to be a demand, and I fail to see demand. So let me put it that way. So I think I fail to see demand for that. If the demand would be there, then I could entertain a different scenario for the future. So I'm generally skeptical that once we issue our own Iñaki pegged stablecoins, then everyone will demand the Iñaki coins. No, I mean, the market wants $1, doesn't want my coins. That's kind of the way I think about the first question. Now, whether there is a consensus on EMEs, either large or small, on what is the proper response in terms of regulation, or more general to the market, my impression is that there is no such consensus, but there are many different approaches, right? So there are some approaches whereby there is a recognition that there are some services that stablecoins could offer in terms of speed and convenience and whatnot, that in principle could be offered by some form of either infrastructure or money type of asset in the domestic economy. And that's why I think many emerging markets are very advanced in fast payment systems, for example, which are a natural tool that would solve many of the problems or many of the issues that could generate a demand for stablecoins. Conditional on having stable macroeconomic frameworks and whatnot, of course. If you don't have those, then people will demand stablecoins, but not because of the payment function or payment convenience. It would be more kind of an indictment of their own domestic currency, the fact that they are demanding a dollar stablecoin. Then there are other countries that will either as a complement or as a separate alternative to fast payment system will develop their CBDCs or as a potential alternative to provide similar services. So I think there are various approaches, and I think here all of them are equally valid. I think it's just a function of what are the constraints, political, economic, and otherwise in any given jurisdiction, and also what are the preferences of the domestic constituency, right, of the citizens in terms of payment services.
So I guess the response, what I learned from you is that the proper response is to actually to allow it to realize its potential for financial inclusion, stuff like that. But in the meantime, consider its own country's systematic risk, stuff like that, like monetary policy, stuff like that. Correct?
Yeah, I think that's fair. I mean, I think I look at the evidence in the market, and I'm still waiting to be convinced that stablecoins improve financial inclusion. But I'm open.
I see.
I'm open to the evidence, and I would as Keynes said, if the facts change, I change my mind.
Isn't that obvious? Because now somebody can send money right away to their own country. That's very little cost. Isn't that financial inclusion?
Yeah. So those, So I think that, I think that's fair. No, absolutely.
Right.
I think that bit of the equation is definitely true. So when I was making my statement, I have kind of the bigger picture in terms of what explains the larger volumes. So in the bigger scheme of things, those transactions they're not gonna add up too much in terms of volume, and that's why I kind of was probably unfairly dismissive of those. But of course, those transactions are very important, even if small, for the people that undertake them,
right,
and actually can improve the lives of many people all over the world.
Right.
Of course.
Now, if we think about the U.S. Now, because besides the stablecoin, actually, U.S. is really pushing for the all the financial assets to be on chain, stuff like that. Do you see this as a fundamental change of how the financial system functions, and the on-chain part will play a major role, or you are still very kind of cautiously suspicious? Where are you at? How do you feel about this?
Again, personal view.
Right.
I probably would. I have to think about the right word, but your choice of words actually strikes me as reasonable, cautiously suspicious. Perhaps something along those lines, in the sense that I strive to see a future in which everything is tokenized and everything is done, on a blockchain.
Right.
That's just perhaps my lack of vision or lack of imagination. And again, I'm open to convincing, but at the same time, I think many of the issues can be solved without, a blockchain. So I would like to be convinced about what is the issue, what is the kind of the real demand use case that is being solved by a blockchain that cannot be solved by a fast payment system, by regulating interchange fees, by making something that tries to reduce the cost of remittances, and so on and so forth. And at the same time, like a concern that I always have in many of these discussions is that I am concerned about the fact that the use of tokenize this, tokenize that, tokenize equities, tokenize ETFs, what have you, is just a euphemism for or we're doing a securities transaction but without complying with securities regulation. It's kind of this regulatory arbitrage sort of story.
Right. Right.
And this is something that I find concerning. I'm not saying that this is the case always, but sometimes it can be. And when you have a boom like this, where people in riding the boom kind of neglect some of these considerations, then you might have instances in which people are effectively doing something that under current regulations is either forbidden or is subject to a certain regulation that is not being complied with. So that is a concern I have with this.
Yeah.
Emphasis
My
on
final comment is that I think I like your first comment is that you can issue your on-chain money, but it's got to have some value. And the US dollars its value proposition is relatively clear. But I think for the other countries, for example, China, because it in this case that if it wants to push for the globalization of the RMB, and it has a lot of the import and export. So that is actually there's clearly a demand for it for its efficiency. But of course, China is conflicted by its own capital control stuff. It's kind of conflicting. Yeah. But I see your point. Thank you.
Yeah. Can I make a quick comment? It seems to me like the
Yes.
global stablecoins is kind of a way to redesign or deregulate in all aspects. Like if you look at the RWA, I don't want to advertise, but there are two cryptocurrency exchanges that you can directly buy the SpaceX spot token today. There is a price quote there. So you can definitely see that so it's kind of blurred the boundary between the primary market, the pre-IPO versus the IPO, and there is definitely a value. And I'm always very skeptical about the survey that hope people use a stable coin that the PBOC surveyed EU merchants that very few people tell them that we accept the USDT. But it's essentially pretty large by like my communication with another licensed Hong Kong stock cryptocurrency exchange. And also another message that if you look at the Hong Kong Stablecoin Act or regulation, Circle and Tether didn't apply at all. But if you look at the licensed crypto exchanges, they are still handling USDT and USDC. To some extent, just there is a kind of a multiple equilibrium theoretically. If you grow big enough in other regions and to some non-US countries without or regions without a strong regulatory power or kind of they cannot really ban if so I talked to HKMA and say, okay, can you ban USDC and USDT and ban the on-ramp off-ramp? It's kind of impossible because they are the largest and they didn't even bother to obtain a license in Hong Kong. I guess that's kind of like the dilemma of the stablecoin regulation globally, that different stablecoins carry its own privacy, KYC, KYT rule. And seems to me is like getting to be a global competition on that. So yeah.
Yeah, absolutely. So I think the position in which financial regulators are in is not something to envy. It's a very tough one.
Yeah, it's not the place they were comfortable with before. Yeah. All right. Any question from the audience? All right, great, Iñaki. Oh, so thank you for sharing your paper with us with Luohan Academy today. Thank you so much.
Thank you very much for the invitation.
Thank you
and for the
very much.
engagement.